Welcome to the Volatility Contraction Pattern Walkthrough. This is a trading pattern that's been proven time and time again, and it's used both fundamental and technical filters combined to surface the best performing companies on the ASX and different markets. What we've got is a download to walk you through the same details we're covering here. So you can click on that link in the description below to get your own download sheet to walk through this criteria and that book summary on your own time, on your own charts, and use those filters. We talk about the fundamental filters, the percentages that we're looking at, the types of fundamental scans that we're applying. We also talk about, and we'll show on the screen, the charts. We're going to look at examples of charts to show what the contractions look like, some examples, whether it's time or whether it's percentage, and using the two together to show how it's contracting, along with the volume side of things. We also want to bring that into the equation because it helps improve the performance. The other aspect that we've seen significantly increase the performance of VCPs and trading patterns across the markets is the strength of those industries. We want to be leading. We want the leading companies to be where we're focusing our trading attention. So we zero that in and have a look at the reasons why a strong fundamental backing, a tailwind of political, legislative, commodity prices, market forces are driving the whole industry along. When you have that tailwind behind your leading company and the VCP criteria, they've led to the best trades that we've seen in the market in years. We're going to move over now into the slideshow where we're going to share the screen so that you can walk through and see the slides with us in real time. Now what we've got here is title page, cover page. These are our trading tutorials, and this is from Finer Market Points. What we do at Finer Market Points is connect leading market themes and top performing companies for better trading. Then we overlay that with these trading patterns like volatility contraction patterns, other ones like the Springs tutorial that we put out earlier this month. Also pocket pivots and high and tight flags, the ones that we're regularly using. But we're walking through this pattern to understand the overlay of what we're doing today. What is a VCP? We're going to have some blue chip examples to show that they're not just small and mid cap stocks that run phenomenal performance and percentage returns. We're also having a look at the blue chips to see massive gains in these large and liquid companies. There's also showing gains out of the VCPs. We move into the fundamental filters. This is what Mark Minervini talks about in his books and explores the undertone of the company. The chart might be phenomenal, but is it a profitable company? Is it attracting the attention of institutional investors that have mandates to only hold profitable or growing companies? Then we have industry scanning and the importance of that of increasing the likelihood of a profitable trade. We move over to technical formation. That's where we're looking at the charts and the overlays, and then the technical filters that are used as well. We have some rules of thumb and then the SEPA, as well as some taking profits in this strategy. As we move through, we're going to have a look at the volatility contraction pattern. So the VCP is a reliable trading charting pattern that is often found at the base of a massive price gain. We're going to have a look at many examples there. What we talk about is found in the base of a massive pattern. So if we look at the chart down here, we see that it's rounding out a bottom. If you think of it as a cup, if you want to use cup and handle from a William O'Neill perspective, just rounding out. So as the market's been falling and falling and falling, it eventually slows in speed. Think of a pendulum swinging. It's coming down, reaching the apex of the bottom, and then it slows down, contracts in volume and volatility, and then starts climbing back up again. And we're going to see this example here of Fortescue in more detail. But what we're seeing in the contraction, we're seeing one large drop, fast and sharp, 25%, 14%, 9%, 7%. So we're seeing it contracting and getting slower and slower, thinking of that pendulum swinging and rounding out a small movement. You can see the lines here that we've got a bit of an apex happening. So that's contracting into it before exploding up the right-hand side. So it's identifying in this area here before it starts to break out and climb. That's the critical part that the volatility contraction pattern and the SEPA aim to identify. So Mark Minervini is the founder of the VCP, or volatility contraction pattern. Now, he used it to become 3 times US trading champion, and he did that in 1997 when he entered and won the investment with a long-only portfolio. So he used only long stocks, not long and short, not geared. He was managing 155% annual return over the period, and that got him first place. That shot him into the limelight, and then he explored and wrote his books, which we're really summarizing here, as to how to trade that VCP. Some blue chip examples that we've had in recent times show 10-bagger returns from very liquid companies. So Fortescue Metals, FMG on the ASX, had a VCP in August 2018 And then it ran from January 2000 up to January 2019. We're getting massive returns on those for Fortescue. We also saw Sezzle, so that was on the ASX, a lot like Afterpay, which is a large ASX top 20 company now. But it had 100% gain after a VCP in August 2020, and that ran to January 2021 for 100% gains. We saw CSL, so that is one of the largest companies on the ASX. Depending on when you cast the net and have a look at it, it has been the largest at some points. It moved from $200 to $320. For the ASX, that is a very high share price. Most companies on the ASX are well and truly under $100 per share. So this is one of the largest and most liquid, most heavily traded companies on the ASX with huge international and institutional investment. And there's a VCP in there from September 18 all the way up to June 2019 when it had that massive gain of more than 50%. That is a huge movement for one of the market's largest heavyweight companies. Top 10 at the time, moving up the ranks to getting towards the top couple of few, depending on where Commonwealth Bank and BHP were at the time. We also saw $30 climb back to $44. Again, more than about a 50% return there. This is a VCP from August 2015, moving up to April 2018 from Woolworths. Woolworths is one of the two oligopoly grocers in Australia, along with Wesfarmers that spun out Coles. Those two companies have a real stronghold on the grocery market in Australia, and that's one example of 50% gain from a blue chip company again, as a top 20 really climbing. So it's not just small and micro caps that benefit from VCPs. It happens across all time frames and all stocks. Now we're going to move into the fundamental filters and the VCP criteria. So there are fundamental filters. We're looking at the company's financial data. We'll look at earnings, sales growth, and the like, as well as profits. There's also industry groupings. This is critical, and we've shown this many times on the ASX, along with our own research, showing that it can double the likelihood of a favourable pattern turning into a profitable trade. The industry groupings are really fundamental. That's that tailwind happening behind the company itself. It's one thing to have a good, strong company, but it's another thing to have many macroeconomic tailwind events occurring at the same time. It could be FX movements, it could be legislative changes and political changes, it can be commodity movements. What we've seen it with lithium and uranium stocks throughout 2021, and we saw it with many of those critical minerals as well, with those minerals that go into batteries and electric vehicles have all skyrocketed, but they've done it together, and that shows the support and industry association, or what Jesse Livermore called sister stocks. When we run those filters at the same time, it highly increases the likelihood of when we see a VCP, it becoming a profitable trade. So that's really important that we're consistently covering. Then there's a technical checklist. We're going to walk through that because there's constructive price patterns and supportive volume movements that we want to be seeing from VCPs. Having a look at the fundamental filters, we want to see strong earnings. So most stocks that have a VCP, break out and then run hard, even if it's before they run hard, they've often had fundamental and technical outperformance against the rest of the market. So they've normally had consecutive quarters that they have in the US or Australia, we have every 6 month reporting, consecutive sales growth, earnings growth, increasing market share, profit margins and the like. They're the fundamental growth and really success story that they've already had before the share price breaks out. That's some of the filters that we want to see, because if we narrow the field down to have a look at those that are earning really well, and we've got a great example of Novonix in a minute that we'll have a look at, that is fundamentally strong, then that's a great precursor, because that tells us that there's a strong likelihood there's going to be institutional support behind these companies. Large funds, ETFs, those that run filters and scans across companies, as long as they tick those boxes, they're in their universe of being able to buy. And that's where we want to get that huge momentum. We want to be buying and having them buying behind us, pushing the share price up. So often seeing success already breeds more success. We also see coming out of a bear market or a correction, 90% of the big winners begun to surge out of bases from bear markets. Sometimes they extend from extended bull markets that we have seen in the last couple of years. But if you cast the net back and have a look over the decades, we do see that most of the best performing companies and their best returns come out of a bear market phase or some sort of contraction. So that's what we do see as a good breeding ground for those opportunities. Have a look at uranium stocks and lithium. They did go through some downward and bear phases before they shot out for these massive runs in the last couple of months or year or so. So that uranium is a phenomenal example of that bear market correction. We've still had a bull market for the rest of the stocks, But for uranium itself, it's been in the bear market for some time. It's turned the corner, and that's a great example of coming out of that bear market correction. We also have 10 years since IPO. If we have a look at uranium, it's another great example. The ones that are older, the more well-established ones like Paladin and the like, have a lot of legacy to push through. We've seen the best percentage returns come from the smaller companies that have recently listed. What Mark Minervini says in his books is that it's less than 10 years since the IPO. So it's important it's signaling the importance of being open to new industries, companies, and the like. Afterpay on the ASX, one of the best performing companies that we've seen, it's only been listed in the last 5 years or so. Their performance really shot out of the gates around 2018 in the last 3 years, and that was about 2 years after listing. So that best performance, that huge gain, is from a recently listed company, and that's what Mark's signaling here. The importance to being open to new industries and new companies. We talk about Afterpay because that was, in a way, a revolutionary new idea. While lay-by and buy now, pay later had been around through other companies like Flexi Group, Afterpay really coined how it was being deployed to online purchases, online shopping, and e-commerce. That's where their signal, that's where that new openness is really showing the opportunity. Now, we also look at the smaller mid caps. Afterpay, again, a great example, and a lot of the uraniums, the old staples from a decade ago in the top 50, the mid caps on the ASX, the uranium leaders, all fell down to be smaller mid caps. Their market capitalizations were obliterated and fell off a cliff. They were out of most of the scannings, the filters, those top indices, and they became smaller mid caps. They've turned the corner, and you only need to look up almost any uranium company on the ASX to see how they performed. The smaller mid caps have run rings around the blue chips. So that's really important. So not just looking at the blue chips that we've shown can benefit from VCPs, but the vast majority of opportunities that we see, especially in Australia, come from small and mid caps. So they're the fundamental filters that we're applying when we're looking at these leading companies. Some examples of those fundamental filters are earnings per share of over 15% per annum. This is coming out of Mark Minervini's book in the summary. So we've got revenue growth of over 10% per annum, and then profit margin growth of over 1%. We apply these filters on a weekly basis when we're having a look at high momentum and high velocity companies. So you can come back and have a look at those videos that come out on Fridays and Saturdays. And that's where we're applying these filters to high momentum companies. So these are what Mark Minervini applies, and we use them on a weekly basis to scan the ASX for those top trading criteria. Other filters that we look for is relative strength. So what we're talking about here is the share, is that company that we're looking at outperforming the rest of the market? That's a relative strength. So when we look at the rest of the market in Australia, the ticker is XJO. That's the top 200. What the S&P 500 is to the US is the XJO for Australia. So when we're surfacing these companies, when we're surfacing these industry groups, whether it's lithium, uranium, copper, cobalt, or it could be buy now, pay later companies, all the way through to fund managers, we want to see that they've outperformed. We want to see that they're already doing better. As we talked about before, the fundamental filters show that the best performing stocks have already had a good run before they break out and start their phenomenal run. So they're not secrets, and we don't need to look and surface those unpolished diamonds and find the diamond in the rough, because if we apply these filters and look for relative strength, they're going to stand out already. That's what we're surfacing in those high momentum companies and the fundamental filters as well on a weekly basis. When we look at the earnings announcements, we want to be seeing surprises. We want to see analysts' positive revisions. Afterpay is a good example of where the analysts consistently chased it up. Now, it wasn't profitable, so it's hard to call it a real VCP for those other filters that we were talking about a second ago. But they do have earnings surprises. What they were doing during their massive climb is increasing their market share, talking about massive sales revenues coming through. That's where we want to see. So that's where the 4, the 10, the 52 are. We want to see exponential movements. Mark Minervini goes into great detail in describing them in his books about these earnings surprises, these movements, these updates, and this is something that William O'Neill has looked at as well. You want to see positive news. You want to see them beating expectations. That's what we're talking about with earnings surprises, is doing better than the market expects. And you can easily see that on the share price when you see massive green bars and viable gap ups, to use a phrase from Gil Morales and Chris Karcher, which is another company, another trading strategy we've looked at in more detail. A great quote from Mark Minervini is that he says, in general, 3 or 4 to as many as 8 to 10 industry groups or subgroups lead a new bull market. So think about the market in the last 12 months. We've had those critical minerals, we've had uranium, we've had a few other pockets that really shot the lights out. and kept powering higher. We're looking at 8 to 10 industry groups or sub-industries that have led throughout 2021. And that's consistently happening. That's why we're surfacing all the time with the leading market themes, so that creates our shortlist to drill down and apply the fundamental filters and then look for VCPs, because in the likelihood, that's where we're going to get the best trades from. So putting those fundamental filters together, it's really coupling of what many have done for over a decade. We saw Jesse Livermore in the 1920s talk of having $100 million profit in one day with using the approach of sister stocks, talking about industries and sister stocks, companies moving together. Talk about the banks in Australia that move together, uranium miners all across the globe that trade together, along with lithium, cobalt, and copper miners that trade together. You also have the buy now, pay later companies. When one leads, a lot follow at the same time. And we've shown that in great detail with lithium companies throughout this year, where one shoots out and starts running. Within the next 2 months, it drags most of them up. We've looked at the correlations in great detail and shown that when one leads, you'll often have over the next couple of days more and more breaking out of a similar pattern. We've also looked at it from a uranium perspective and surfaced that as well, showing that when there's a leader, they don't all break out on the same day, but they often lead each other in a couple of days. And that's a really interesting insight to look at on the Australian market and commodities. We also see from William O'Neill in his cancelling modelling, that's another strategy in detail and a video in itself, but it is looking at filtering companies, being open to new industries, open to new subsectors, and open to new areas of the market from the IPO perspective, hot new technology, whatever they want to call it. Another one that uses the fundamental filtering is Thomas Bulkowski. He's called it the holy grail of trading. In analysing the markets in many different ways, out of all the research that he's done, he talked about the industries being that holy grail. If you're able to pinpoint that leading industry and then identify the right trades within it, it dramatically increases the chances of that trade being profitable. He also spends a lot of time about talking about patterns, but if we overlay these with fundamental filters, it increases it even more so. And finally, Gil Morales and Chris Karcher, they're an extension of William O'Neill's methodology. They call themselves the O'Neill disciples, and in their book, 18,000% Return in Stock Market, they talk about in detail of using the pocket pivot and trading methods like that. Also overlay those strong cancelling and industry methodology that has been talked about, and there's proven points from all these successful traders in history. Now, we move on through, have a look at industry scanning, because that's what we do at Final Market Points, because the market can have a broader theme, such as growth, value, small cap, large cap, and so on. But then we drill down to see the latest market leading themes, because as we saw, the NASDAQ has led throughout 2021 on a more anemic levels. The current news is showing that there's much less base of rising companies. About 70% of the NASDAQ leaders are actually under the 200-day moving average, and well and truly off their 52-week highs. Whereas we've got the leaders, the FANGs, if we're going to simplify it to that, are still pushing higher. So we've got a real disparity in performance. But within that, there's obviously a leading group, and that's what we focus our time and attention, because as we've seen the market still going higher, the Dow Jones and S&P have been churning sideways in a whippy fashion and increased volatility from less gain. We've still had good, strong gains throughout the year, and that's what we're consistently doing. So if you want, subscribe, we'll get those updates consistently coming through of surfacing the fundamental filters, the top 6 of a thematic on the ASX and how they perform, often 50, 100% gains for the month. And then we also apply the momentum to look at a proprietary method of scanning the market for strong momentum stocks, and then applying Mark Minervini's VCP fundamental criteria to really come down to a short list. Now, as we move over to the trend template, we're going to look at bullish chart criteria and break it into 2 sections, because this is how Mark Minervini describes it in his book. The trend template, it wants to look at the current stock price above both the 150-day, about 30 weeks, and the 200-day or about 40-week moving average price lines. So think of this as about the annual average, and then more like 2/3 of a market, 3/4 of a year average prices. So what we're looking at is it's going up. That's really what that's simplifying. And that's what we talked about before with the NASDAQ, most of them being under the 200-day moving average. Now you want to see the 150-day moving average above the 200-day moving average. So that's really where you see the long-term trend of the 200-day moving average is being outpaced by the 150-day moving average. What that says is that the last 150 days are running faster than the whole 200 days. So it's still an upward bias. You also want to have that 200-day moving average line trending up for at least 1 month. So it is possible to meet this criteria while the longer-term pattern is still downwards. what we want to be seeing is really 4 to 5 months of that 200-day moving average, the average price still going up. That's what we really want to be seeing. That's what the third point's signaling. The 50-day moving average, which is about 10 weeks, we want to see that above the 150 and the 200-day moving average. That's saying that the last 10 weeks have been moving faster than the months before it. Even though the months before it have been increasing, the 50-day moving average is being increasing at a faster rate. So that's telling us that it's accelerating into the pattern. Now, the current stock price is trading above the 50-day moving average. So that's saying even though it's been contracting in some way, shape, or form, we want to be seeing it up in the top right-hand corner of the chart because that's where the best patterns come from. We'll see that with Minervini. We'll see Fortescue Metals being on the other side after it's been on a huge downtrend and very rapid price move as iron ore prices fell. The other bullish chart criteria, you want to see the current stock price at least 30% above its 52-week low. So you don't want it to see down, rounding out new lows, fresh lows for the year, which a lot of the NASDAQ companies are. So many of the best selections will be 100%, 300% or more above their 52-week low. We're going to see that with Minervini and a few others that will surface in a second, because that's where they've already run hard. They have some sort of consolidation, but they've run hard off the back of fundamental news and good technical trading. They're having a continued base, so building a base up on that higher level before projecting themselves even further. And we will see that in a second. The last point is the current stock prices are within at least 25% of its 52-week high. The closer to the new high is the better. So if you have that massive run up, you then have a consolidation that's tightening as it's getting closer to that 52-week high and then breaking out. I want to see it rally and then really drop off. There are still VCPs that trade and profitable trades out of that, but this is the preference that Mark Minervini talks about. So we move over to the technical trading list. And when we look at this, we're going to have some examples. He's mentioned 2 to 8 contractions that we looked at before, and that's ranging from months to years. It can take, say, 2 months to have 2 or 3 contractions, or it can be years where we have 4, 5, 6, sometimes 8 contractions. We'll show you what those contractions look like. You want to have a retracement. Generally, about 25% is a good retracement. So from the rally up, it retraces about 25% from that absolute high where it pinpoints and crumbles back from. Then it rallies a bit more, maybe a 15% rally, and then it contracts, say, 8%. And then you're seeing that tighten up significantly. That's where you're seeing that contraction. The rally, 25%, 15%, and then 8%. They're smaller contractions, obviously smaller numbers. We also want to see that progressive volatility reduction. While these retracements might be smaller, you also want to see the candles or the intraday trading reduce in range. You want to see the volatility intraday reduce, and then also the volume as well, which goes hand in hand from a Wyckoff perspective of showing the reward for effort. Progressive volatility reduction in both price and volume, and we're going to see that in the examples. Now, the number of contractions, most VCPs are really 2 to 4 contractions. Sometimes they're up to 8 contractions and progressively getting smaller each time. It's rare to see some over 4 contractions, whether that's the current market cycle. I'm not to comment on that, but 8 contractions is really a rarer one to see. Now, the time frame, normally within a couple of months, there are some that are up to years. They're the rarer ones, and they might show up on weekly charts as well. So that's some of the criteria. Then we move into the specific entry point analysis, what Mark Minervini calls SEPA, S-E-P-A. He looks at the trend, specifically an uptrend. We've talked about that from the technical and the moving averages, so that's ticking the same box. Fundamentals, consistently improving earnings and revenue growth, as well as margins like profit margins. We've talked about that with the fundamental filters that we're surfacing on a weekly basis. We want to see a catalyst, whether that's institutional interest, say an ETF, a stock moving into an indices, like we're having a reweighting at the moment. The S&P consistently reweight their indices. And then suddenly an ETF has to buy this stock. We saw it with Fisher & Paykel Health just after the COVID lows in 2020, and it ran from it being a small cap all the way to a mid cap, and suddenly many more indices had to buy it within 1 quarter. That can be a catalyst that can show massive institutional support. They're mandated to buy the company. There be new products, such as a supply contract, CEO, or drug approval. We see Novonix be revolutionary in their way of improving how battery minerals are utilized. That can be one as well, because we have a demand for those commodities after the critical minerals and Joe Biden's election over a year ago. We also have entry point. So most market leaders provide at least one low risk entry point where VCP helps indicate the timing. We've really built upon this because this is critical from a risk reward perspective. If we're deploying our capital, we want to risk the least amount possible. So we overlay this with also a pocket pivot used by Gil Morales and Chris Karcher, and then also Wyckoff theory, because we want to really be pinpointing that and risk the least amount of money possible. We'll have the overall arching filters for VCPs, and then when we're trying to time the entry on VCP, we'll also use pocket pivots and Wyckoff theory to help time those entries. Exit points, all trades do come to an end. So look for an end of a super performer. No matter what the trade is, always have stop losses for every single trade. There's a great quote here from Mark Minervini. If we're short-term trading, what the share price does after we sell is irrelevant. We're just participating in a portion of the stock's share price continuum. Now, we've had that with Novinix, and we've also had it with John Lyons Group in the last couple of months. We've traded it a few times, taken profits along the way, but not been in for the whole leg because we're short-term trading on these signals. We move into the first example, Pilbara Minerals. The VCP here ran from January 2021 to June 2021. The VCP then led to 149% gain over 6 months. What we see here is a daily price chart with a 200-day moving average being the red line, the green line is the 50, and the blue line is the 10-day moving average. We see the volume bar chart down below. The blue boxes show the volatility contraction patterns. It's easy to see that we've got 3. What might not be as clear is that the first contraction is a 36% reduction over 43 days, 43 trading days. The next contraction is 19%, and that's only over 9 days from high to low to round out that contraction. The next one, coming from 19% to just under 19%, 18.8% is over 9 bars. So same duration and about the same percentage movement. We do see it contract. Now there is a pocket pivot buy point in here. That's the low risk entry, or you can look at it from a Wyckoff perspective and identify a spring if you're able to do that. And you can look at our tutorial link below to understand more about it. As we move through, we're going to have a look at the rally that ensues. In the next couple of months, it really shoots the lights out and runs hard. It comes out of this VCP, the first contraction, the second contraction, and the third contraction, breaks out from a pocket pivot and keeps on running. So it puts on that huge gain, 149% over the next 6 months. If you want, you can download a finer detail of the VCP criteria to walk through your own charts. You can click on that download link below to work through that. The next one is James Hardie Industry. This contraction happened over a slightly longer period. You'll notice the 200-day moving average has the 50-day moving average well and truly above it, and it's showing an uptrend. We're seeing the contractions get higher and higher in the chart, and it's really close where these contractions are occurring near the 52-week average, 52-week highs. That's just saying it's consistently pushing higher near the annual highs, which Mark Minervini said is even better for a VCP. First contraction is 20 trading days, 17%. Next one is 17 trading days over 11%. We've got 12 trading days down to 7, 17%, 11%, 7% down to 3.9%. The last contraction is only 4 bars. From a Wyckoff perspective, we're seeing the volume dry up. We're seeing tight range closes here. We're looking at inside days. These inside days really show congestion. There's lack and inability to close lower and then really tightening up. Then we do see a pocket pivot and take that buy point here of a high. The volume is higher than the last 10 preceding days with a strong candle, and then breakout off it goes. That's the low risk entry point that Mark Minervini is talking about. We couple the VCP with a leading filter that we've already applied to the market, showing the industry is strong, and then applying the pocket pivot for that timing of the trade along with Wyckoff. Novinix, NVX, has been one of the best performing companies on the ASX this year. The performance is nothing short of stellar. Now, the VCP from January 2021 to July 2020 is signaled here with lots of contractions. We said it was rare to get more than 4 contractions. We've got that here. There's 6 compressions, and the volume dries up significantly, as we see down the bottom here. The volumes are really dried up. You're seeing huge movements, huge averages, and like that basketball dropping in the share price and getting smaller on each bounce, the volume is also getting smaller on each bounce. Looking at these 6 contractions in order from left to right, we've got 11 bars with a 38% drop. We've got 8 bars with a 37% drop. We expand in time a bit more for 26 bars, but only drop 20% over that time. The contraction in volatility is getting lower, but the time is taking longer. We're back to 11 bars for a 25% reduction, so it's slightly increased, but it's coming back towards the red line, this 200-day moving average. We're down to 12 bars and a 15% reduction. And then finally, we've got 7 bars with only an 8% reduction. For a highly volatile share, 8% over 7 days has been quite tight. Then we see the volume dry up significantly. Breakout with a pocket pivot, this strong green candle, is the first signal that it's really being broken from a Gilmore's and Chris Karcher perspective. From a Wyckoff perspective, here's the buy signal much earlier. Kind of closes and really showing that it can break out and start that rally. Talking about a share price coming from $2.20, $2.30 or $40, depending on which signal you use to buy, getting over $12 per share in the next few months. August, September, October, November, December. Within 6 months, it's rallied that hard. 98 trading days, 457%. It's a worthwhile trading pattern to look at the VCP and couple that with a pocket pivot. Now we move over to John Lyons Group, another one we've traded in now. This is a trade that we did place. We've also placed in Novonix as well, sold out well and truly before $12. John Lyons Group, VCP from August 2021 to November 2021. This is recent. December is where we're recording at the moment. We've got 4 contractions, 3 contractions, and the volume dries up with tight closes. Then leads to a 40% gain in 28 trading days. What we see here is 9 bars and it's reduced 18%. Then we see 13% reduction and we've had that over 5 days. It blows out to the 8 bar contraction, but it's only lost 7% over that longer duration. So we're seeing this contraction tighten. Critically note how this contraction, the low is much higher than the previous lows, where we've seen other examples where the lows have dropped. We just see the contraction really tighten up in the upper end of the range, and then we're going to see the volume dry up as well. So volume and volatility both dried up in October. And if you see the 4th contraction, this tiny one here that we didn't signal because it's so small to get the numbers on, and then cross over with the breakout point. There's a pocket pivot, there's a buy point here on the pocket pivot in this day, and then leads to the rally, or there's another buy point here on the final contraction with the pocket pivot trading out and breaking over the swing high, or as Gary Glover would call it, the B wave. We're seeing that movement break out and then lead into that massive movement, 40%, 28 bars, 28 trading days, away it goes for John Lyons Group. Now, we're always surfacing those industry scans that we're looking at, and we're really looking for those leading market thematics. We're applying the fundamental filters of Mark Minervini on a weekly basis to surface the top momentum, and then also the high velocity companies that are moving behind the ranks. That's really filtering through the bases, and that's where we want to be looking for the VCPs. So the high momentum is one thing, it's already started running. Fundamental filters can signal us ones to watch in our shortlist, but the other ones before they break out are those high velocity companies. So you can subscribe for those updates, click on the bell so you get alerted to them, and then consistently work through those trading ones. Also, download the link, download the summary below to understand how to trade volatility contraction patterns in your own time. We break down the details of these patterns, of these scans, and of these filters in more detail.